If you haven't heard that 2024 is an election year, I'd have to ask what rock you live under and if I could join you there. Everywhere you go,
Politics, politics, politics. Yes.
but if you're like me, what you really care about is profits, profits, profits. But that's just it, right? Won't whoever gets elected drastically influence how the market performs? Won't candidate A throw us in a deep recession where every stock loses its value? Won't candidate B cause every stock to double in price and make us all millionaires by 2025? I understand your fears, believe me. However, in this video, I want to take a sensible, logical, and most importantly, informed look at how the 2024 presidential election might really affect market dynamics. By the time we're done, you might feel a whole lot better about the whole thing. Thank you for watching this video. But before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. Historically, elections have been known to inject a mix of optimism, uncertainty, and speculation into the stock market. These factors in turn have a lot of influence on both investor behavior and market trends. Of course, 2024 is different due to a wide range of political circumstances. And while these add an interesting dimension to the already complex relationship between politics and market performance, they also tend to be exacerbated by news stations and pundits who make money off your attention. Let's start by looking at precisely what we're dealing with. The road to the 2024 presidential election began with the Iowa caucuses, an event traditionally viewed as the bellwether for the national political mood. Of course, this early stage of the election cycle is critical as it sets the tone for the primaries and offers insights into the candidates' political strategies. These strategies are often viewed as early indicators of potential policy directions that might impact the market. If one candidate gets flustered and decides to start talking about universal basic income, for instance, the market will understandably react to that news. However, there's rarely a correlation between what's said on the campaign trail and what actually happens once a candidate is in office. While we're talking about it, the Iowa caucuses haven't picked the final Republican candidate in over 20 years. So while Iowa put former President Donald Trump firmly in place as a Republican frontrunner, something that most people expected, I'd take that with a grain of salt. His candidacy also adds a layer of complexity to the market's outlook. After all, Trump's presidency was marked by significant market fluctuations driven by both policy decisions and changing international trade relations. His current run for president raises questions about a potential return to such policies and their implications for international trade, regulatory environments, and market stability. On top of that, Trump is not extremely popular outside of his base. President Biden's potential unchallenged run for the Democratic nomination presents a different set of considerations. His administration's policies, particularly those related to fiscal spending, environmental regulations, and social welfare, have their own implications for various market sectors. The lack of a strong, youthful movement behind him, as was seen in the Obama years, might also influence investor sentiment, especially in industries focused on technology and renewable energy. It's also important to remember that even though Biden has not proved himself too radical in terms of policy, his party is often associated with regulation and other investment-hindering actions. Combine that with partisanship and his age, and Biden is nearly as controversial as Trump. In order to determine what each candidate might mean for the stock market, we have to put politics aside and take a more nuanced approach. Markets not only react to policy announcements, but also to investor sentiment, which can be swayed by political developments. Of course, investor sentiment is not always a very rational thing. As news stations amp up their rhetoric for the election cycle, it can lead to increased volatility, mainly due to investors trying to anticipate and react to potential policy shifts. Taking all of that in, let's look at the past few election years and compare the various market reactions. Let's start with the one that has by far the most extenuating circumstances to consider, 2020. Any investor will tell you that the 2020 election year was a testament to the market's volatility in response to unprecedented events. If you remember, COVID first hit in March of that year, and it cast a huge shadow over the entire election. The pandemic-induced economic downturn and subsequent recovery, propelled by substantial fiscal stimulus and accommodating monetary policies from the Fed and Congress, showcased how external events can overshadow election-related market movements. This period also highlighted how government actions can directly impact market sectors like healthcare and technology. As for stocks, the crash witnessed after the shutdown was largely over by November, when most indices recovered and went on to finish the year higher. Analyzing the 2016 and 2012 election years, we see patterns of market downturns followed by recoveries. In both cases, stocks initially started the year in decline, but began to move higher by mid-year before dropping again in early fall. However, they eventually all rallied again to end the year higher than expected. Such fluctuations not only reflect the market sensitivity to political uncertainty, but also its ability to adapt to changing political landscapes. Of course, the impact of these elections on different market sectors varied, with some sectors benefiting from specific policy proposals while others faced challenges. As you can see, despite the unique circumstances surrounding each election year, the market has a propensity to follow overarching trends. Understanding these patterns can provide a framework for investors to make informed decisions. While it's crucial to recognize that each election cycle is unique, it's rare for markets to make drastic moves based on election cycles alone. The market's trajectory in 2024 is likely to be influenced by a combination of election outcomes, policy expectations, and global economic conditions. Clearly, the strong performance of 2023 sets a high bar. Still, investors should be prepared for potential volatility as the market responds to the unfolding political narrative and adjusts to both corporate earnings reports and economic indicators. Remember, markets are at record highs right now, so a pullback could still happen regardless of where the election goes. Any expectation for the stock market in 2024, while it should be informed by historical trends, should also consider current global economic conditions. This includes factors like inflation rates, interest rate policies, and international trade dynamics. While a year-end rally is a possibility, the path to it could be marked by significant fluctuations as the market reacts to the latest political and economic developments. This wouldn't be because one candidate necessarily destroyed the market, but due to hundreds of different factors all working in concert. Given this, investment strategy should stay grounded in a long-term perspective that looks far beyond the immediate political landscape. While presidential elections can have short-term impacts, the market's long-term trajectory is more closely tied to fundamental economic indicators and corporate performance. As with non-election years, successful investing involves looking beyond the political cycle and focusing on solid fundamentals. The good news is that election controls are stronger this year than in 2020. So regardless of who the nominee or winner is, we are much less likely to have the mess we had after the last Biden-Trump matchup. The bottom line, tune out the political noise. We live in a hyper-connected world, and I know that the constant stream of political news can be overwhelming and distracting. However, a disciplined approach to investing based on thorough research and a well-consigned strategy can help us navigate the potentially turbulent waters of an election year. Still, we need to focus on the underlying value and potential of our investments rather than allow our strategies to be influenced by short-term political developments. As we move through the 2024 presidential election year, the interplay between politics and the stock market will continue to be a focal point for investors and analysts. And while the election may lead to some degree of market volatility, the historical pattern suggests that the market's long-term growth trajectory is influenced more by fundamental economic factors than by political events. When in doubt, trust the numbers, not the news. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.